3 years ago, I handed my uncle $8,000 to invest in dividends. He promised I'd get paid just to hold stocks. Sounds amazing, right? I got a crash course in what they don't tell you on YouTube. Not because dividend investing is a scam, it isn't, but because I walked in completely blind and the full picture looked nothing like the highlight reel. So today we're doing something most finance channels won't. Dividend investing versus growth investing, side by side, stress tested. Because you've got half the internet telling you dividends are passive income paradise and the other half calling them a tax-inefficient trap. Both sides are oversimplifying. Let's figure out what's actually true for a beginner. The dilemma. Here's where most new investors get stuck. You've got some money, maybe a few $100s a month, and you go online looking for answers. Instead, you find two camps screaming at each other. Camp 1, buy dividend stocks, get paid every quarter, financial freedom. Camp 2, dividends are irrelevant, total return is all that matters. Growth stocks will crush dividends over 30 years. If you're a beginner, you're just standing there like, okay, which one is actually right? Honest answer, it depends on what you're optimizing for. Let me break both down properly. Option A, dividend investing. Dividend investing means buying shares in companies or funds that regularly distribute a portion of their profits to shareholders. Quarterly cash payments deposited directly into your brokerage account. Here's what the enthusiasts get right. There's something psychologically powerful about receiving cash without selling anything. Own 500 shares of a company paying $1.20 per share annually, you're getting $600 a year, $150 per quarter, just for holding. That's real money. And for people building toward retirement income or who want to avoid selling during downturns, dividends serve a genuine purpose. The data backs this up. Between 1973 and 2023, dividend growers and initiators in the S&P 500 returned an average of around 10.3% annually, compared to about 4.3% for non-dividend payers over the same period, according to Ned Davis Research and Hartford Funds. That's a meaningful gap. Here's what most people miss, though. Dividends are not free money. When a company pays you a $1 dividend, the stock price drops by roughly $1 on the ex-dividend date. You didn't gain anything. You just received part of your own investment in cash form. It's like breaking a $20 bill into two $10 and calling yourself richer. And then there's the tax problem. In most countries, dividends are taxed as income the year you receive them, even if you reinvest. In the US, qualified dividends are taxed at 0%, 15%, or 20%, depending on your bracket. Higher earners pay taxes every single year on that passive income, which quietly drags your compounding. Dividend investing has real merit, especially for income-focused investors, but beginners need to understand what they're actually receiving. Option B, growth investing. Growth investing means buying companies or index funds that reinvest all profits back into the business instead of paying dividends. Think Amazon for most of its history, or a broad index fund like VTI or VOO. The mathematical case is strong. Retained earnings reinvested at a high return on equity compounds your wealth without annual tax drag. You only pay capital gains when you sell, and long-term rates are often lower than ordinary income rates. You control when the tax event happens. Here's a concrete example. $10,000 in an S&P 500 index fund at 10% annually grows to roughly $174,000 in 30 years with full reinvestment. Apply a conservative 15% tax drag on just a 2% yield, you lose about 0.3% annually. Sounds tiny. Over 30 years, that's $12,000 to $15,000 in lost compounding. Real money quietly disappearing. The growth camp is also right that total return is what matters. A stock returning 12% annually with no dividend beats a 9% stock with a 3% dividend every time on a total return basis. But here's the part that surprised me when I actually dug into the data. Pure growth investing requires iron discipline. When the market drops 35%, which it has done multiple times in the last 25 years, and you have no dividends coming in, and your portfolio is just a number going down on a screen, a lot of people panic sell. The dividend investor, meanwhile, is still receiving quarterly checks. That cash flow is psychological ballast. It keeps people invested. Growth investing works brilliantly on paper. It requires you to behave like a disciplined robot. Most beginners aren't robots. The verdict. Here's my honest take. If you're in your 20s or 30s, investing for retirement 25 plus years out, with the discipline to stay the course through bear markets, a low-cost total market index fund likely serves you better than a dividend-focused portfolio. The math favors minimizing tax drag and maximizing compound growth over that horizon. But if you need tangible returns to stay motivated, if that quarterly dividend notification keeps you from selling when things get scary, a dividend strategy isn't a consolation prize. It's a behavior management tool. And in investing, behavior is often the biggest variable. The smarter move for most beginners? A blend. Own a broad index fund as your core, something like VTI. Then allocate a portion to a dividend-focused ETF like SCHD, which holds quality dividend growers with a historically strong total return record. You get the behavioral benefit of cash income without abandoning growth. One warning: don't chase the highest yield you can find. A 7% or 8% dividend yield is usually a red flag. It typically means the stock price has already collapsed, inflating the yield. Dividend growth matters more than dividend size. You want companies that can keep paying and raising dividends for decades, not ones dangling a high yield while their fundamentals erode. What you can do today: open your brokerage account today, not this weekend, today, and look up 2 ETFs. VTI for total market exposure, SCHD for dividend growth. Read their fact sheets. Compare 5-year and 10-year total return numbers, not just yield. Decide what split fits your personality and time horizon. Then set up an automatic monthly contribution. Even if it's $50, the amount matters less than the habit. The worst dividend versus growth debate is the one that keeps you out of the market entirely while you're hunting for the perfect strategy. Start. Adjust as you learn. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making financial decisions. Every investor's situation is different, and what works for one person may not be right for you. If this cleared up the dividend debate for you, subscribe. We break down these investing comparisons every week without the hype. Drop a comment: Team Dividends, Team Growth, or somewhere in between. I read everything.